Welcome to the Deep Dive. Today we're digging into Cboe Global Markets, ticker Cboe, and their Q3 2025 earnings call.
Yeah, and this wasn't just, a good quarter.
No, definitely not. The market reaction alone told you this was big, overwhelmingly positive.
Absolutely. I mean, for anyone watching, it was textbook, a real beat and raise quarter. But honestly, the numbers, while strong, weren't even the whole story.
Right. It was the strategy announcement that came right after.
Exactly. They didn't just report success. They basically announced a major re-architecting of the business, a big pivot.
Okay, so let's unpack that. But first, the victory lap numbers, adjusted EPS.
Came in at $2.67. Consensus was looking for $2.53. So a solid 5.5% beat there.
Nice. And top line?
That strength flowed right through. Net revenue hit $605.5 million, also beat consensus. And that's 14% year-over-year growth.
14% is strong.
It is. And what's maybe even more interesting, especially given the strategy news, is the efficiency. Adjusted EBITDA margin expanded significantly, 380 basis points year-over-year. Jumped right up to 67.5%.
Wow. Okay, so that shows discipline even before these big strategic changes they announced.
Precisely. That margin strength kind of sets the stage perfectly for the main theme of the call, which was management saying they're, quote, sharpening focus on core derivatives leadership.
Right. Not just sustaining margins, but actively pruning things to double down on their strongest areas.
Exactly. This is where it goes from just, improving things incrementally to really transforming the business profile.
So what's getting pruned?
They announced they're initiating sales processes for Cboe Australia and Cboe Canada.
Okay, the international exchanges.
Yep. And they're also discontinuing their U.S. and European corporate listings efforts.
Listings are out. Anything else?
Yeah, trimming costs in some smaller areas too. Things like ETP listings, Cboe Europe derivatives, and some smaller risk and analytics businesses. Basically cleaning house.
Okay, but selling off Australia and Canada, I mean, doesn't that maybe suggest they overpaid or those acquisitions didn't scale as hoped? And taking a 3% hit to net revenue sounds risky.
That's a totally fair point. Look, divestitures often mean something wasn't the right fit or didn't hit the scale needed. Yes, these non-core bits, listings, the smaller international platforms, they probably required a lot of management time, regulatory overhead for, maybe marginal returns.
Sort of low margin distractions.
You could see it that way. They become anchors. And yeah, there's execution risk in selling, finding buyers takes time. But the financial logic they laid out is compelling. It looks highly accretive.
Okay, so what is that logic? How does the math work?
Well, management was really explicit here. They expect all these moves, including that 3% net revenue reduction you mentioned, to be massively offset.
USOS cuts?
Exactly. They're expecting an 8% to 10% reduction in adjusted operating expenses using their 2025 guidance as the baseline.
Wait, so a 3% revenue dip for potentially a 10% EPS drop?
That's the math. It's pretty undeniable.
Yeah, that really suggests those businesses they're shedding were barely breaking even or maybe even losing money in a fully loaded cost basis.
It strongly implies that.
Yeah.
And they stated this whole realignment is expected to be accretive to overall earnings. Plus, it supports stronger free cash flow conversion heading into 2026.
Which, for you listening, means more cash available for buybacks, dividends, or reinvestment rather than propping up less efficient parts of the business.
Right. Management stressed it wasn't just about financial capital, but freeing up human capital, management attention, to focus on the core.
Okay, so let's shift to that core. Where is that focus going? The derivatives engine sounds like it's absolutely humming.
Oh, it is. The options segment. Fifth straight record net revenue quarter. Up 19% year over year. That's real durability.
Driven by?
Their proprietary products mainly. Index options average daily volume, or ADV, climbed 15%. That's fueled by their S&P options complex. But the really pivotal number, I think, is still the zero DTE options on SPX.
Right, zero DTE. We hear that constantly. Maybe just quickly remind us what exactly is zero DTE and why is it such a big deal for Cboe?
Good call. So zero DTE just means 0 days to expiration. These are options contracts that expire the very same day they're traded.
Super short term.
Extremely. They allow traders, both institutional and, sophisticated retail, to make very precise short-term bets on market direction or volatility or hedge immediate event risk. It taps into this huge demand for ultra-short duration exposure, high frequency, high leverage.
And Cboe basically owns this market for the S&P 500 index, right?
They do. They have the key index licenses and the deepest liquidity. And the growth is just staggering.
How much staggering?
SPX 0 DTE ADVs surged 62% year over year.
Yeah.
62%. And get this, zero DTE now accounts for over 61% of all S&P options volume traded at Cboe.
61%. Okay, so that's not a niche product anymore. It's central.
It's absolutely structural. It's changed how people manage short-term risk, and Cboe is right at the center of it.
Okay, but it wasn't just derivatives carrying the load this quarter, right? Data Vantage looks strong, too.
Yeah, Data Vantage, that's their market data and tech services unit. Net revenue there was up 12% year over year, and they actually raised guidance for it.
What's driving that growth? Just price hikes?
That's the crucial detail, no. They said nearly 90% of that growth came from new unit sales and new subscriptions, not just price increases.
So real demand pull.
Seems like it. Primarily, they said, from international customers wanting access to their proprietary U.S. market data and also newer, more complex offerings like dedicated network cores or precise timestamping data.
Got it. We also saw decent numbers from cash and spot markets.
Yeah. Solid. Net revenue up 14% overall in that segment. European cash equities were particularly strong, 24% growth there. And global FX held up well, too, up 13% year over year. Durable.
Okay, but let's be balanced. There was one weak spot.
Right. Have to mention it. Futures net revenue was down 22%, primarily just lower volumes.
But offset elsewhere.
Partially, yeah. As they noted, the higher volatility environment that might hurt futures volumes tends to boost options volumes. And frankly, with this strategic pivot, weakness in a smaller segment like futures just doesn't impact the overall story as much anymore.
Right. The focus is shifting. So connecting all this back to the guidance they delivered, the raise part of beat and raise.
They did. Full-year total organic net revenue growth guidance was lifted. Now they expect low double-digit to mid-teens growth. That's up from high single-digit before.
Significant bump.
And they nudged up the Data Vantage organic growth guidance too, now targeting high single-digit to low double-digit.
And on the cost side, reflecting the new strategy.
Yep. Adjusted OPEX guidance for the full year was trimmed down a bit to $842 million.
Right.
Reflects that discipline and the beginning of these strategic cost cuts.
Faster top-line growth, tighter cost control. That really reinforces the idea of structurally higher margins going forward.
Exactly. Which leads us to the really interesting part, I think the emerging catalysts. Where is all this newly freed up capital and, maybe more importantly, management focus going?
Prediction markets seem like a big theme.
Huge theme. Management sees it aligning perfectly with those trends we saw in zero DTE, the appetite for short-dated contracts, smaller contract sizes, more event-driven trading.
What's the potential scale there? Is it big?
Well, here's a fascinating comparison they drew. Think about the average daily premium traded in S&P options. It's around $18 billion.
Billion with a B. Okay.
Now, compare that to the existing event and prediction market products out there today. The daily premium traded is less than $50 million.
Wow. Okay, that's massive white space.
Immense. If Cboe can design regulated prediction contracts that capture even a tiny fraction of that existing appetite for short-term risk, the upside is enormous.
And they made a key hire to target this, right?
Yes, J.J. Kinahan, a real retail brokerage veteran. He's now heading up retail expansion and alternative investment products.
That sends a pretty clear signal. They're serious about bridging their institutional strength into the broader retail or active trader market for these new products.
It absolutely does. It's about designing the right products and getting the distribution right. If they make prediction contracts as accessible and seamless as short-dated options have become, that $50 million daily number could explode. This isn't just financial engineering, it's product innovation for a new audience.
Okay, what else on the innovation front? AI was mentioned.
Yeah, they talked about AI efforts, mostly internal focus for now using it to boost productivity, leveraging their data platform on Snowflake and AWS. They have a center of excellence, like 900 people working on it.
Any plans to sell AI-driven insights?
That's the longer-term plan. Commercializing unique data insights derived from their AI work, potentially adding another layer to Data Vantage revenue.
We also saw that filing to expand trading hours for U.S. equity options.
Right. Towards 24/5 trading eventually, but this step is meaningful now. Adding hours from 7:30 to 9:25 a.m. Eastern and a bit after the close, 4:00 to 4:15 p.m.
Why is that important?
It lets traders manage risk around key economic data releases that often happen pre-market. It addresses real customer demand for more continuous risk management capabilities. A step towards being truly global, around the clock.
And finally, the crypto elephant in the room. Any updates?
They're getting closer. Planning to launch Bitcoin and Ether continuous futures. These are key, long-dated, cash-settled. The goal is to capture some of that massive perpetual swap market that currently exists mostly offshore unregulated.
And bring it into a regulated U.S. exchange environment.
Exactly. They want to be the regulated venue for that kind of continuous crypto futures exposure once they get the final regulatory green lights.
Okay, so you've got optimization through divestitures, internal innovation with AI and hours, and then these big greenfield shots in prediction markets and regulated crypto. It's a pretty clear catalyst map.
It really is. Which brings us nicely to our This Is Not Financial Advices segment. Time for an outrageous but maybe plausible trade idea based on all this.
All right, let's hear it. The core insight seems to be Cboe transforming itself, right? From a collection of platforms into a much leaner, focused derivatives and data powerhouse.
That's the essence. Higher margins, clearer story.
So the trade is?
The outrageously plausible trade idea. Go long Cboe and potentially short a peer exchange. Specifically, a smaller, maybe less focused peer that still relies heavily on slower growth, lower margin businesses. Think maybe pure spot equity trading or traditional listing services.
Okay, what's the thesis behind that pair trade?
It's a bet on strategic clarity. Cboe has this clear roadmap now. Execute the divestitures, keep growing Data Vantage, successfully launch prediction markets and crypto futures. Each step should drive margin expansion and potentially re-rate the stock higher.
While the
peer might lack that clean narrative, might be stuck with lower margin segments, less clear catalysts for margin expansion. So you're betting that Cboe's focused strategy earns it a higher valuation multiple relative to a less focused competitor.
A bet on focus and execution driving superior returns.
Pretty much. The market seems to be rewarding that kind of strategic clarity right now, especially in the exchange space where complexity can sometimes obscure value.
Okay, so to wrap things up quickly, Cboe delivered a strong quarter, beat and raise, but more importantly, they laid out a very clear strategic pivot.
Yep, sharpening the focus intensely on derivatives and data, shedding distractions, and aiming for higher growth and profitability.
Which leaves us with a final thought, maybe a provocative question for you, the listener, to mull over.
Right. With Cboe now really prioritizing its resources, both money and people, under leaders like J.J. Kinahan, towards these new retail and prediction market opportunities. How quickly can those new greenfield businesses, like event contracts, actually start to move the needle on revenue? Can they replicate even a fraction of the explosive success they'd had with zero DTE?
That's a great question, because that's where the real blue sky potential might lie beyond the core improvements.
Okay, that's our deep dive. Remember, none of this is financial advice. Always do your own due diligence.
Thanks for listening.